There's a meltdown happening in the multifamily space. And of course, with crisis comes opportunity, this incredible opportunity. The deals are just going to be extraordinary here over the next 12 months.
What do you think is going to continue to happen with multifamily? What's your kind of prediction here?
There's no question they're going to continue to go down. When my portfolio crashed in 2008 and 9, I was at a 30% loan to value in 2007. In 2009, I was upside down. Insurance is going to be an issue for any asset in those markets. We're just going to have to muddle through, and pricing is going to have to adjust based on what's happening with insurance. We're in some economic uncertainty right now. The proverbial, you know what's hitting the fan. Welcome to another edition of Lifetime Cash Flow through Real Estate Investing. I'm Rod Khleif, and I am thrilled you're here. And you are going to love today's guest. You know why? Because it's me. So I've got my co-host Mark Nagy on. What's going on, Mark?
What's going on, Rod? I'm glad we're digging into this stuff because there's a lot of big changes that are happening in the real estate market right now, and I'm glad we're able to touch on it and just do some big value add, I think, here today.
Yeah, well, we'll do the best we can with that. I think that, that's why I'm being interviewed today, guys, because I wanted to drill down on quite a few things. Mark's got a list of questions to ask me that we can go into as to what's really happening, because really there's a meltdown happening in the multifamily space. And of course, with crisis comes opportunity, this incredible opportunity. So Mark's going to ask me questions. We're going to get into it. I think you're going to get a ton of value from today's episode, and let's do it, brother.
Yeah, I think we'll start a little broader here, right? Because there's the rate cuts, there's the election coming up, all those sorts of things. But just kind of start general in terms of what you're seeing. How are you feeling about the multifamily market, the single family market? What are you seeing out there in terms of where things are going over maybe the next 12 months and just really where they're at right now?
Sure. Well, there's a lot of questions you just asked. So let's start with multifamily. Okay. So in the multifamily space, there are a ton of operators in trouble right now. They got adjustable rate bridge debt. Rents have pulled back in many markets, in markets that I'm in, even, Texas, Georgia, the Carolinas. Occupancy has dropped. So, there's a lot of stress in our business right now. And so, operators that haven't been through this are really struggling and trying to come up with solutions. And I've never seen so many multifamily properties on the market as I'm seeing right now. I literally get dozens of emails a day of new properties hitting the market. Sales are down about 90%. And so, again, there are incredible opportunities coming in. So I'm excited. I mean, we're in a lot of cash. I got access to a lot of cash, and I think the deals are just going to be extraordinary here over the next 12 months. And a lot of people are in the sidelines. A lot of the bigger players are in the sidelines. So in the multifamily space, I see a tremendous amount of opportunity. There's going to be some upset. There's already been some foreclosures. There'll be more foreclosures. Banks taking assets back. But, as it relates to the 2008, 2009 crisis, this is different in that it's specific to multifamily for the most part. Office, we're going to see massive pain as well. I mean, occupancy across the country is at about, 60, 65%. Those assets don't break even unless they're 80, 85%. Now, right now, banks are kicking these loans down the curb because if they foreclose, that immediately hits their balance sheet. So they're doing everything they can to avoid that. So a lot of them are doing what's called deferrals, where if they've got what they consider a credit-worthy borrower, they will defer the interest or a portion of the interest or the payments or a portion of the payments and put it on the back end. And I think it is just kicking the can down the curb. So we'll see. We'll see. But so that's what's happening in the multifamily space. And other asset classes in commercial aren't doing as bad. Retail, mobile home parks are okay. I'm trying to draw a blank here. We talked about industrial. Office. Oh, industrial's doing great. So there's some other asset classes that are still doing quite well, but multifamily definitely is going to see a reckoning, and there's going to be opportunity. And so now let's pivot and pivot to single family for a minute on an overarching comment. There is a huge shortage of housing in this country. I mean, and the fact that this administration had an open border policy, and there's, I don't know, people are saying upwards of 20 million people have come into the country. That housing shortage, we were 5 million housing units short before that happened. Okay, so there's a huge housing shortage. How that impacts pricing, I don't know. Right now, pricing is still stable, and it's even still gone up compared to a third. I think it went up like 9% across the United States from the third quarter of last year to the third quarter of this year. Now, when the Fed drops the rates more, I think it could really open things up, and we're going to see prices go up again. But that's not my wheelhouse anymore, and so I don't pay quite as much attention to it. We are becoming a renter nation. There's no question about that. The disparity between, rent pricing and mortgage payments is still very wide and makes it very difficult for people to buy single family properties. And, one of the things we should talk about is some of the impact of the election on all of that. Let's do that later. But
all in the market, because of interest rates, multifamily prices are down, anywhere from 20 to 25%, just depending on the market. I know you just talked about distress and things like that. So what do you think is going to continue to happen with multifamily? Do you think it's going to go even further down next year in 2025? Is it going to slowly start to go back up? What's your kind of prediction here?
There's no question they're going to continue to go down. Yeah, there's absolutely no question. We're going to see much deeper price cuts. And we're also seeing lender delays affecting this whole scenario, this distress. See, when rates went up, Fannie Mae and Freddie Mac reallocated a lot of their analysts to other departments in Fannie and Freddie. And if you guys don't know that, Fannie and Freddie is probably the largest source of debt for multifamily assets. There's also insurance companies and there's bank loans, but Fannie and Freddie are the conforming debt solution for multifamily. And they reallocated a bunch of their analysts when the rates went up. I mean, things slowed down. So now they don't have enough analysts they don't have enough to do new business. They also don't have enough to do servicing properly. So, for example, if you're changing management companies, it takes forever to get their approval. I'm dealing with that on an asset right now. It should have taken a week. We're already at about 5 or 6 weeks to try to get a new management company approved. Or, a lot of the draw requests are taking forever. So a lot of times, these lenders will hold money that you draw on to do repairs, and the requests to get those draws out are taking forever, which is killing, these operators' ability to handle these properties because they put the money out, they don't get it back in a reasonable amount of time. We're seeing that on our deals as well. So that reallocation of analysts, they already didn't have enough. And with the reallocation and now pulling them back in and everything, it's just a mess at Fannie and Freddie Mac. And so, that's really impacting these operators as well. So anyway, that's in the multifamily space. Now in the single family, I will tell you that I think home sales are going to remain constrained right now as long as the rates stay around 6%. Here's the reason. A lot of people, 86% of the homeowners out there have rates under 6%. So the rate is going to have to get closer or below that before owners are going to want to sell. And so that's also constraining inventory and constraining sales. And, I'm going to tell you that the Federal Reserve doesn't see inflation going sub 2% on a consistent basis until 2026, which could mean, higher short-term interest rates. They'll decline, but they'll still be higher. They won't decline them like they raised them to try to curb inflation, these past couple of years. So, the only kind of bright thing in the whole piece here is that there's a huge growing supply of newly built homes. So the supply for new single-family homes is rising, it's about 2.5 times the level of existing family supply. That will affect pricing as well. So we'll see, but of course prices are very geographically driven and market dependent, based on the inventory. So,
Let's talk about that here.
Yeah. Okay.
Right. Because that's big time what we're seeing here in the market, right? These areas that had huge booms during COVID, places like Florida, Texas, Arizona, etc. Those are the places that are the coldest right now. The places that were the hottest are now the coldest, and the places that were the coldest then are now the hottest, right? Places like the Midwest, if we're looking at the places for this year with the highest rent growth, you're seeing places like Kansas City, Milwaukee, Cleveland, Pittsburgh, Columbus, Ohio, Indianapolis, Cincinnati. I know you own some assets in a few of those places there. Mm-hmm. And then places with the biggest rent declines, obviously Austin, everybody knows that one. Raleigh, you mentioned the Carolinas, Jacksonville. Some of my properties are getting rent declines right now. Texas, Phoenix, Tampa, Dallas, etc. So what are your feelings on, if you were to give advice to the listeners short term, and then long term, do you see those places coming back in terms of Texas and Florida? What are your thoughts on still where to buy right now and maybe over the next 12 months? What would be your advice?
Well, I'll tell you, the reason they pulled back is because they grew exponentially. I mean, we saw 1 year in Tampa, rents went up 32%. I mean, do the math on that, okay? It's insane. And so it was inevitable they were going to pull back some. So that was inevitable. But, we're in some economic uncertainty right now. The proverbial, what's hitting the fan. And, God knows what the election results are going to, how they're going to impact what's happening. But, every one of those markets you just said are great markets. I've got assets in most of them. Yes, we've seen rents pull back. Yes, we're struggling on some of them to get occupancy up and keep, we've had to cut back on our return projections, but that's business. That's part of this business. And so, those are all great markets to still invest in. Now, I don't have a crystal ball to go short-term or long-term, candidly, but I will tell you, I would invest in every single market you just said. Okay. And so, yes, you're right. That initial group of markets you mentioned, which included Cincinnati and Kansas and some other markets you mentioned, those are doing better right now. And I will tell you, when 08, 09 happened, that whole Midwest region was fairly stable. We saw the biggest price increases and decreases in the coastal cities and the South, Florida, Vegas, California. They all had huge price increases and then they crashed. When my portfolio crashed in 2008 and 9, I was at a 30% loan to value in 2007. In 2009, I was upside down. Okay, so that means my portfolio dropped more than 70%. So yeah, you're going to see these big fluctuations in these coastal and southern markets, but I will tell you, I'm still very bullish on the South. I'm still very bullish on Texas, where we've got a ton of assets, the Carolinas, parts of Georgia, Florida for sure. Now, of course, there's a whole insurance dynamic that's going to impact things in a big way. I was in Europe when Helene and Milton hit. And, when Ian hit, I had about $1 million worth of damage. I settled for under $1 million on my compound. Well, this time, luckily, I didn't have any damage to my buildings, but my boat ended up 3 houses away. My jet skis ended up in my backyard. My dock is destroyed. It's hilarious. It looks like something out of Dr. Seuss because it's leaning different directions as you're walking down. It's hilarious. But insurance is going to be a real problem for any of these areas that were impacted by those storms. I mean, look at what's happened in the Carolinas. My God, they're still searching for bodies. It's horrific. I thought candidly that Milton was going to be a lot worse because it was coming in at 1 a.m. I thought I was going to get flooded. Thank God it wasn't as bad as I hoped. I mean, yeah, people died, but not as many as I anticipated. So anyway, insurance is going to be an issue for any asset in those markets. And we're just going to have to, muddle through, and pricing is going to have to adjust based on what's happening with insurance. So, that's what happens is the market adjusts this pricing. And that's why the politicians need to stay the hell out of it, because the market will adjust based on what's happening. And, when politicians print money, is when things get screwed up. I mean, that's why inflation, I think they're BS in the inflation numbers, candidly. Maybe you've heard me talk about this on the show. I mean, literally our debt is going up $1 trillion every 100 days. I mean, it's insanity. We're paying over 1.2 trillion a year so far on that debt. About 2 billion a day, I believe it is. I mean, it's insane. And so, and in the last 4 years, 80% of the currency's been created. Up until 2020, only 20% of the currency was in place. Since then, we've created another 80%. I mean, hello, this is why we have inflation. And so don't get me started on politics. In fact, we should probably talk about the election. You want to talk about that?
But before we do, really quickly, I'll actually give you some data that supports exactly what you just said. And obviously places like Texas and Florida, they still have the long-term fundamentals, right? Jobs are still going up. Population is still growing up. So I totally agree with you. And if we look at, I have a chart here and it talks about what were returns in the real estate market after every time that the Fed started cutting rates. 2007 was actually the only one in the past 50 years to where returns actually went down over the next 2 or 3 years. So the dot-com bubble in 2000, returns over the next 2-3 years after the Fed started cutting rates were massive. 1989, 1984, and 1981. I don't know if you can speak to what those were, but apparently the Fed started easing rates at those, and there were massive returns after that.
And there were crashes then, the S&L crisis. There were crashes then, and so that's why they had to.
So
right. Well,
I can't speak to that. That's why I asked. But there were still massive returns over the next 2 to 3 years, so it's not something to be afraid of.
Right.
But yes, let's talk about the election. I know you mentioned. Well, where do you want to start? Insurance or election?
Oh no, I mean, we talked about insurance. I think. I mean, let's talk about the election next. Let's do that. So what's the impact of the election results going to be on the housing market,
if any?
Okay. Oh, trust me, they're huge, freaking huge. Okay, if Kamala Harris gets elected, I mean, guys, you can hate me for this. I don't give a shit. I think we're doomed. Okay, she's suggesting a $25,000 credit to go to first-time home buyers. Okay, well, who pays for that? I mean, hello, how fair is that to the people, to the first-time home buyers that are buying right now? I mean, come on. Also what she's talking about putting in is a removal of tax benefits for investors that own more than 50 single-family homes. Okay, and so obviously that hurts our business. Okay, she thinks that's going to help. I get a lot of hate online from people like, yeah, you shouldn't have owned 800 houses. You're driving up prices. That's BS. And I'm going to tell you that anytime politicians screw with the tax benefits in the real estate game is when we have serious problems, as evidenced by the S&L crisis. That was an example of that. The politicians got involved and it created this crash in savings and loans that were loaning a ton of money on commercial real estate. She's done a pledge to build 3 million new houses over 4 years. Well, that's great. I mean, fine. That's good. A tax incentive for home builders to build more starter homes and rental properties. I agree with that one. Okay. But the 25,000 thing to me is insane. Okay.
Oh no. Yeah. When you give money to people.
Yeah. Somebody's got to pay for that stuff. I mean, that's just like the whole student loan, thing where they were going to pay off all the student loans. Well, who's paying for that? What about the people that actually had to pay, like my daughter, for her student loans? That's not fair. So when you remove these key tax benefits for major investors, it discourages, investment. And that's the death knell of any democratic society is when investment is discouraged. It hurts affordability as well. And I'm going to tell you, there are build to rent investors out there and that are providing family-sized housing that if they get, if she goes down that path, it's going to discourage that as well. Whether she likes it or not, we need investors to invest in single-family rentals. And, more capital invested in single-family rentals means lower rents for families. And so removing those tax benefits is going to increase rents, and so, I disagree with most of what she's trying to do. And I mean, if you listen to me, I'm definitely on the other side anyway. But Donald Trump's housing policies is he's going to reduce illegal immigration and ban mortgages for immigrants that don't have a legal status. I mean, hello, that makes sense to me. Okay, people that don't have legal status here. He's going to open up federal land for home construction. I think that's brilliant because there's millions of acres of federal land that could help with that. And here's the big one. He's going to eliminate a lot of the costly regulations to make homes less expensive to build. Because, I mean, a lot of these municipalities, they make it damn near impossible to get something built. Here in Sarasota, don't get me started. Good Lord. It takes forever to get permitting done. The regs are ridiculous. And so That's a big one. That one really will help if you can minimize the freaking governmental red tape so you can build. And then, he's encouraging construction of houses on the outlining areas like the periphery of cities and suburban areas where the land is cheapest. So, I think that well, where I'm at on that whole conversation, but yeah,
totally agree. You think about these things logically. Whenever the government
right.
gives out money, it always comes back to bite you in the ass. Think about inflation. Why are we in massive inflation? Because the government printed money and just gave it out to everybody, and now it's costing everybody way more. Same thing with the housing. If Kamala or whoever it is just gives away $25,000, all it's going to do is just inflate housing prices even more, right? And it's just going to they're just going to add that right on the back end, and houses prices are just going to go up by 25,000.
Yep.
Right. I know we're throwing a lot of data at people.
Yeah, guys. Yeah, exactly, guys. So, you may want to listen to this again.
We're throwing a lot of data at people today. Elections, interest rates, all these things impact the housing market. It's complicated. For people that might want some help to learn, some of the basics, or maybe even get, some mentoring and coaching from you specifically, Rod, how can they do that?
Sure. Well, I've got my boot camp, my live boot camps coming up here November 8th, 9th, and 10th in Orlando. It's the only live one I do each year. It's 3 days. It's not a big sales pitch. I literally talk about my coaching for like 30 minutes, and you'll leave knowing how to pick a market, how to evaluate a market, how to find deals, how to evaluate them, how to build a team, how to finance them, how to raise all the money you need for them, how to syndicate, how to joint venture, how to property manage. I mean, everything. You're going to leave knowing all that. So if you're interested in attending that live event in Orlando, if you put the code, when you check out, you want to go to multifamilybootcamp.com, but when you check out, use the code podcast and you come for $197, and it'll include my document library and my finding deals course. Okay. So, hell, those two things alone are worth 10 times that. So again, go to the Multifamily Bootcamp website, then use the code podcast when you check out for $197 price, and you'll get those two bonuses. Now, if you want to move faster, I've got my Warrior Mentorship Coaching Program, and, we've got, 15 to 1,700 warriors around the country, literally in every market. They own somewhere between 210 and 220,000 units that we know of, which I'm very proud of because I've only been teaching a little over 6 years. And if you're interested in applying to that and basically paying for speed, as it were, that's one-on-one coaching. Text the word crush to 72345. About this, if there was ever a freaking time to get into this business, it is right now, because the stuff is coming, guys. I'm just telling you, it's coming. So.
And by the way, I'll just throw in my 2 cents real quick, because I invested in Florida during the COVID boom and made a ton of money. Right now, those things are hurting. The only reason, Rod, why I've been able to pivot over into the Midwest just temporarily for a couple of years to get better returns is the Warrior Group, and been able to do multiple deals this year with other warriors. There's no way I would have been able to just jump into a whole new market and do it all myself if I didn't have those connections.
Right. No.
And now I've been able to do two deals this year in whole brand new markets, and we've been killing it on them.
Love it. Love it.
So just thought I'd mention that. So last thing we'll get into, interest rates, right? Another confusing topic. The Fed started cutting rates temporarily after that. Interest rates have actually gone up about 0.5 percentage point here in the past few weeks. So where do you see these rates going, and what's that going to impact, and what's going to happen?
Well, what I'll do is I'll tell you what each of the big governmental organizations and associations have predicted for interest rates. Okay, so Fannie Mae's latest forecast predicts that 30-year mortgage rates are going to end at the end of this year around 6.2%, but they're going to drop into the 5% range in 2025. But by the end of next year, they could fall to 5.7, for example. That's Fannie Mae's opinion. Okay, now Freddie Mac in September said they think rates are going to decline further this year, but remain above 6%. They also said that, because the Fed is shifting their expectations, it could cause some temporary volatility, which is what we're seeing literally right now. Okay. So the Mortgage Bankers Association is very similar to Fannie Mae. They think rates are going to end in 24 around 6.2, continue to trend down through 25, and they think they could end in the end of 25 around 5.8%, and then hold steady in 2026. Now, the National Association of Realtors, NAR, they think 30-year mortgage rates are going to end in 24 at 6.1. These are all very similar, bottoming out at 5.8 towards the end of next year, and then after that, ticking back up again. And by the way, guys, to give you some context, okay, you're thinking, oh my God, that's high. When I got into this business, when Mark wasn't even a twinkle in his dad's eye, we're talking 1978, interest rates were 18%, okay? And I remember just getting super excited when they hit 7%. I'm like, holy crap, they're 7%. Just to give you some context. And you can make money at any interest rate. Prices have to adjust, obviously, for you to make money. So Realtor.com predicts that the mortgage rates will end this year at about 6.3%. I think there's probably some credibility as they're all similar. I mean, nobody's got a crystal ball, but that's my opinion on interest rates. So, but guys, again, volatility is here. Deals are here. They're coming even more. The market is just kind of going crazy. We're seeing auctions starting to pop up. That's brand new. Deals are here, guys. So again, if you've been thinking about this at all, get your butt to my boot camp, or text CRUSH to 72345, or go to the boot camp website, multifamilybootcamp.com. Use the code podcast. And I'll see you in Orlando.
Well, final words of wisdom on this here, Rod, for people listening that are taking in all this data. What would you recommend? Is now a good time to buy? Should people wait until things change a little bit? What should they do?
I get that question all the time. Should I wait to buy because you're talking about a crash coming? No. Get up to speed now. It's going to take time to get up to speed. You got to build relationships. You've got to learn this business. And that takes time. And so, there's no time like the right now to get up to speed. Now, while you're searching for deals, you very likely will find some now. Okay. But even if you don't, when they hit, you'll be up to speed. You'll know what you're looking for. You'll know how to evaluate them. You'll have, because I'm going to tell you, the first time you evaluate a deal, it'll take you all day. But you'll get to a point where you can do it in 15 to 20 minutes, but that takes time, okay? And so, again, the key is get up to speed right away. If it's not with me, with somebody else, but get up to speed as fast as you can, because you don't want to miss this opportunity, because it could be a once-in-a-lifetime opportunity to capitalize on great deals, okay? So that's my 2 cents there. We'll see you in the next episode, and I appreciate you listening, and I hope I see some of you in Orlando.